everyone, and welcome to my channel. My name is Ashley, and today we have Ms. Nicole Grogan Alston with us. She is a corporate tax strategist born and raised right here in Atlanta, Georgia. She is a mother of four and the owner of DNC Accounting Solutions, DNC Business Solutions, and DNC Academy of Entrepreneurship. And today we are going to be discussing how taxes relate to probate and estate planning. Now let's get into this. Okay, Nicole, can you share with us maybe some of the, for business owners in particular, some of the tax implications for transferring their business ownership to heirs?
Yes. First and foremost, it's going to determine how the business is set up. What's the structure of the business? If it's a sole proprietor, then at that point in time, we want to make sure that it's somewhere written that my business is to go over to this individual. Hopefully it's in this state, but if it's not in this state, it is certain type of ways that the deceased can set up prior to passing away. Some of these things can be like a family partnership, where all the families come together and becoming a partner. They be in a partnership. So the ownership of the interest of the partner that deceased automatically transfers over to the remaining partners because they're family. Then you have what is called family limited liability companies, where it can be the same, where the interest automatically just roll over. Now, when it comes to having partnerships or having individuals in a business that is not family, that is not beneficiaries, it should be written somewhere. And a lot of times, depending on your structure, is going to determine what type of organization documents that you should have in place. One of the biggest organization documents you should have in place is called an operating agreement. And just depending on your sole proprietor, your LLC, partnership, corporate, it's going to be labeled a little different. It's going to be a partnership agreement. It's going to be, corporate resolution agreement. But in that agreement, it should always be a paragraph that determines how the interest of a partner that passed away or a shareholder that passed away, how that interest is going to be handled. A lot of times what ends up happening is that some people just allow the family to take the interest. But what they would want to do is buy that family member out because they're not familiar with the family member. They don't know how the family member work ethic is. And a lot of times it's like, I went in business with your dad. I don't know if I want to be in business with you as the son or as the daughter. So they will, try to buy them out. But of course we want to make sure that this is in all the agreements, no matter what type of structure the business is. We want to make sure that that is in the agreement and that everybody is aware. Say for instance, if you and I was to go and become partners, and God forbid, something was to happen to either one of us, what we would do, we would make sure in that agreement that we understand that yes, our initial investment, our initial interest in the business will automatically go to our beneficiary. However, the partner, the surviving partner, will have the option to buy out that beneficiary. And if that partner do buy out that beneficiary and pay more for the business interest than actually the value of the business interest, then we have capital gain. So they will have to pay taxes on capital gain.
Well, thank you for sharing that with us.
You're welcome.
Subscribe to my channel to learn more about probate real estate, financial literacy, and generational wealth planning.